6 figures. Still broke. That's most Americans. The Federal Reserve confirmed it, not opinion. High income, zero net worth. Totally possible. More money spent means less money kept. Always. Wealth is built quietly, never in plain sight. Your salary is a starting point, not the finish. Student debt averages $39,000 per person. Credit card interest, 18%. That's the trap. 18% grows faster than you can earn. Paying off debt is a guaranteed 8% return. The market averages 8%. Debt costs more. Zero debt is a portfolio position, a strong one. Income without a plan disappears every single time. Your 20s are your most financially decisive decade. Most people skip the foundation, then wonder why. Delayed gratification is the rarest skill in finance. Every want purchase today is a future asset delayed. Auto-pay your bills. Protect your credit score first. One late payment. Years of credit score damage. Good credit saves $44,000 on one mortgage. 0.5% difference. $44,000 lost. Credit score is not vanity. It is leverage. Budget or be budgeted. There is no middle. Needs versus wants. Most people never draw that line. A budget is not a cage. It is a compass. 50% needs, 30 wants, 20 savings, always. Most people spend first. Wealth builders save first. Subscription creep is invisible and expensive. Audit monthly. Cooking at home saves hundreds every single month. Small leaks sink large ships and large portfolios. An emergency fund is the first real wealth move. 3 to 6 months of expenses. That is safety. Without an emergency fund, investing is just gambling. Savings goals give direction. Random saving goes nowhere. A goal without a number is just a wish. Automate savings. Remove the decision. Remove the failure. $250 more per month. Life-changing math. That gap becomes $443,000. Same job, same salary, $400,000 difference. Consistency is the most underrated investing strategy, period. Start at 20, build what 40 can't recreate. The market rewards the patient, punishes the reactive. Time in the market, not timing the market. Every delay costs more than you can calculate alone. The real system behind all of this, that comes next. The first real move, eliminate debt above 6% interest immediately. Student loans at 4 to 6% pay these off strategically. Credit card debt at 18% must go first, always. Once debt is gone, that payment becomes your investment fuel. Your income is not your wealth. Your savings rate is. Open a Roth IRA, up to $7,000 per year tax-free. Roth IRA money grows tax-free, withdrawn tax-free in retirement. Contribute to your 401k at least enough to get the full match. Employer match is an instant 100% return. Capture it. The 401k annual limit is $20,500. Use it. Tax-advantaged accounts first, taxable brokerage second. Order matters enormously. Open a brokerage at Fidelity, Vanguard, or Charles Schwab. Start today. VU tracks the S&P 500. 10-year annualized return near 13%. VTI covers the entire U.S. market, over 4,000 companies. SCHD focuses on dividend growth, income, and appreciation together. A 3-fund portfolio, U.S. stocks, international stocks, and bonds. Done. Diversification is owning less of the wrong things, not just more. Expense ratios compound against you the same way returns compound for you. VU expense ratio, 0.03%, near zero cost. The best account isn't the highest return, it's the one you fund. Automate monthly contributions. Remove emotion from the equation entirely. Dollar cost averaging smooths volatility over time. Consistent beats perfect. Missing the 10 best market days per decade costs everything, 19,000% gone. Fully invested, 19,900% return over decades. Timing, 45%. Probability of loss over 1 day, 46%. Over 10 years, 6%. The longer you hold, the lower the risk. That's verified data. Volatility is not risk for long-term investors. Selling at the bottom is. Index funds beat 80 to 90% of active managers every decade. You cannot consistently beat the market. The data has spoken conclusively. Peter Thiel turned his Roth IRA into $5 billion, tax-free. Not everyone starts that high, but the mechanism is the same for all. Reframe: wealth is not what you earn, it is what you keep compounding. Reinvest every dividend. Every dollar reinvested accelerates the compounding curve exponentially. QQQ tracks the NASDAQ 100. Higher growth, higher volatility. Know the trade-off. The numbers are clear, but there's one piece most people still get completely wrong. Compound interest is not a math concept. It is a boulder rolling downhill. Slow at first, then unstoppable. That is exactly how wealth accumulates. $1,000 per month at 10% becomes $683,000 in 20 years. That same $1,000 per month becomes $2 million over 30 years. Same rate. The boulder principle: early contributions are the push. Time is the hill. Vanguard data confirms average investor underperforms the index by 1 to 2% annually. That underperformance gap compounds. 2% less per year is devastating long term. Behavioral finance shows emotions cost more than market downturns. The 50-30-20 rule applied consistently builds real financial discipline over time. Needs, rent, utilities, insurance, groceries. Non-negotiable, but always optimize these. Wants, dining, subscriptions, entertainment. Enjoyable, but always negotiable and cuttable. The 20% savings allocation is the engine. Everything else is fuel management. Negotiate your rent annually. Even 5% savings compounds over a decade. Drive a reliable used car. The average car payment is over $500 monthly. That $500 monthly invested instead becomes $344,000 over 20 years. The BLS reports Americans spend over $9,000 yearly on transportation. Redirect that. Social Security replaces only 40% of pre-retirement income. Plan the rest yourself. The 4% withdrawal rule means you need 25 times your annual expenses saved. Annual expenses of $40,000 means a $1 million target portfolio. Your income is not your wealth. Your savings rate is the true indicator. Morningstar data shows low-cost index funds outperform high-fee funds over any 15-year window. A high-fee fund taking 1% annually costs over $60,000 on a $500,000 portfolio. Keep fees under 0.1%. That's the only rule that matters for fund selection. Tax loss harvesting in taxable accounts reduces your annual tax bill legally and efficiently. IRS rules allow up to $3,000 in capital losses deducted against ordinary income annually. Rebalance your portfolio annually. Drift from your target allocation silently increases risk. Asset location matters. Put bonds in tax-advantaged accounts. Growth ETFs in taxable accounts. HSA accounts are triple tax-advantaged. Invest the balance after your deductible is met. Inflation averages 3% annually. Your savings account returning 1% is losing money. You now have the system. The only question left is whether you'll actually use it. Over 60% of six-figure earners still live paycheck to paycheck. The problem is never income, it's management. The person driving a 10-year-old Toyota with $1 million portfolio is infinitely wealthier than the BMW leaser. Stealth wealth is the most powerful financial strategy most people have never heard anyone talk about. Now, build the full system step by step. Start with debt elimination this week. List every debt, interest rate, minimum payment, balance. Tackle highest rate first always. Once credit card debt is gone, set up autopay in full every single month going forward. Build your emergency fund in a high-yield savings account. Current rates near 4 to 5%. 3 months of expenses minimum. 6 months for variable income earners or freelancers specifically. After debt and emergency fund, open a Roth IRA and contribute the maximum $7,000 per year. $7,000 per year in a Roth IRA at 8% grows to $1.6 million over 40 years. All of that is tax-free on withdrawal. That's the Roth IRA advantage that changes retirement completely. Now, maximize the 401k, starting with at least the full employer match. That's your immediate return. If your employer matches 3% and you skip it, you just declined a 50% pay raise. Inside your Roth IRA, buy VU or VTI. Low-cost, diversified, historically proven index funds. The S&P 500 has never delivered a negative return over any rolling 20-year period in history. Remember that boulder rolling downhill? Your portfolio behaves exactly the same. Slow, then explosive. The first 100,000 is the hardest. Every 100,000 after that comes faster and faster. At 500,000 invested at 8%, compound growth alone adds 40,000 per year. That 40,000 in passive growth exceeds the average American's monthly income, paid while you sleep. The side hustle is not the plan. The invested side hustle income is the plan. Channel every extra dollar. Lifestyle inflation is the primary reason high earners never build wealth. Every raise needs a savings allocation. Every time you get a raise, increase your savings rate by at least 1%. Just one. Always. Cancel subscriptions you don't use. Cook at home, negotiate rent. These are strategic reallocations, not sacrifices. Every $100 per month redirected to investments adds $81,000 over 20 years at 10%. The full financial system in order. Eliminate debt, build emergency fund, max Roth IRA, capture 401k match. Then invest additional savings into a low-cost index fund brokerage, VOO or VTI. That's the whole system. This system works whether you start at 22 or 42. Time adjusts. The system does not change. If you're starting late, increase your savings rate aggressively. 25 to 30% is the target. Use catch-up contributions. IRS allows an extra $1,000 in Roth IRA and $6,500 in 401k after 50. The boulder is already rolling for those who started early. For everyone else, start rolling it now. Review your full financial picture quarterly. Spending, savings rate, asset allocation, progress toward your FI number. Never stop learning about personal finance. The rules change, IRS limits adjust, tax laws shift, stay current. Consistency over years beats intensity over months. The system only works if you keep showing up every month. The average millionaire next door drives a used car, lives in a modest home, and invests the difference quietly. Federal Reserve data. Median retirement savings for Americans aged 55-64 is only $134,000. The system we've built today, followed for 25 years, produces vastly different outcomes. By design, you don't need to be exceptional, you need to be systematic. The math does the exceptional work for you. Your savings rate is the single most powerful lever you control. Not market timing, not stock picking. Even a 15% savings rate, sustained for 30 years, statistically produces millionaire-level outcomes. Diversification, low fees, consistency, and time. 4 variables, that is the entire wealth equation, complete. Stop comparing your financial life to others publicly displaying theirs. That display is almost always debt in disguise. Build your net worth tracker. Update it monthly. Watching it grow is the most powerful behavioral motivator available. The goal is not retirement. The goal is financial independence. Work becomes a choice, not a requirement. Financial independence at a $40,000 annual expense level requires exactly $1 million invested. The boulder metaphor one final time. Every year of investment is another revolution gathering speed,